The mandate of each by holding market rates below the real rate of return, we encourage investment and consumption that is needed to bring the economy back to potential. That in turn creates the conditions for monetary policy to eventually normalize. It might seem at first glance that this policy is tantamount to penalizing savers in favor of borrowers. But in the medium term, expansionary policy is actually very much to the benefit of savers. Savers can still earn satisfactory rates of return from diversifying their assets, even when interest rates on deposits and saving accounts are very low. For example, US households allocate about a third of their financial assets to equities, whereas the equivalent figure for French and Italian households is about 1/5, and for German households only 1/10. By contrast, German households keep almost 40% of their assets in cash and deposits, and French and Italian households approximately 30%. The equivalent number is less than 15% for US households. In the euro area, we need expansionary macroeconomic stabilization policy to support demand, starting, of course, with monetary policy. That will allow inflation to return to our objective, and in time for policy interest rates to rise back to their long-term levels. But monetary policy cannot raise long-term real rates. That can only be achieved by structural reforms that elicit a structural rebalancing of savings and investment. Higher real returns on savings must come through decisive action on the supply side.
Thank you very much, Mr. Mario Draghi.